So girls, here now we with the same concept we come to now a question with hidden goodwill. Deepika, this is the question of your textbook. It is there. I have the solution. I've typed the solution. The question I'm reading from the textbook. Deepika and Rajshri are partners in a firm sharing profits and losses in the ratio of 3:2. Profit sharing ratio is 3:2. On 31st March 17, their balance sheet is as such. Balance sheet is given here. Let us read the adjustments now. On the above date, the partners decide to admit Anshu. Deepika and Rajshri are the partners. These are the two partners with 3:2 share. They decide to admit Anshu, a new partner, as a new partner on the following terms. The new profit sharing ratio of the three partners, Deepika, Rajshri and Anshu will be 5, 3 and 2. Anshu shall bring 32,000 as his capital. The capital brought in by Anshu will be rupees 32,000. Anshu is unable to bring in cash. They tell that a new partner does not bring the capital in cash, and his share of goodwill also is not brought in cash. Therefore, they decide to calculate goodwill on the basis of Anshu's share in the profits and the capital contribution made by him to the firm. Next, this is the capital contribution and the goodwill that we have to do. Next adjustment is plant and machinery would be increased by rupees 12,000. These are revaluation adjustments given. Plant and machinery increase, that means credit side of revaluation account. Stock would be increased to 40,000. Stock given at present is rupees 32,000. Stock be increased to 40,000. So increase by 8,000 on a revaluation account, in the revaluation account on the credit side. Then provision for doubtful debts is to be maintained at 4,000. Doubtful debts to be maintained at 4,000. Value of land and building we appreciated by rupees 20,000. Value of land and building we appreciated by 20,000 by 20%, and furniture has depreciated by 10%. We will make the adjustments in the revaluation account. And then they say there is an additional liability of rupees 8,000 being outstanding salary payable in the employees of the firm. The liability is not included in the outstanding liabilities, so we have to make the revaluation account. Let us see how we make the revaluation account. See here now the revaluation account. We make the revaluation account with the adjustments. Doubtful debt is to be brought down 3,200. Furniture, outstanding salaries, the plant and machinery be increased to 12,000. Stock to be increased by 8,000. That means 32,000 to 40,000. We make the revaluation adjustments and distribute the revaluation profit in the old profit sharing ratio between Deepika and Rajshri, that is 3:2. This is the profit between 10,680 to Deepika and Rajshri 7,120. This is the profit. Now let us see what does the question say. Next, now in this question the goodwill is hidden, which means which will be found out as such. Now the goodwill has not been mentioned. We will find out the share of goodwill. How do we find out the share on goodwill? We have to find out the share on goodwill which is hidden. If goodwill is not given, we have to find out the goodwill. That means goodwill is hidden. So based on Anshu's share of profit, we have to find out the goodwill of the firm. 32,000, this is Anshu's share. Anshu has come in for 2/10 share. 2/10 share, 32,000. So that means according to his share into 10/2, full firm's capital should be 1,60,000. What is the capital of Deepika? 48,000 is as given, plus the profit on revaluation. We've just found out the profit on revaluation between Rajshri and Deepika. See here the profit on revaluation 10,680 and 7,120. So this profit will be added to their capitals. So we add this to their capitals to find out the goodwill. Capital of Deepika will be the 48,000 as given to us in the balance sheet, plus the profit on revaluation, that is 10,680, 58,680. Capital of Rajshri, 40,000 as given to us, plus that revaluation profit, that is 7120. It becomes this 47,120. And capital of Anshu is as given, 32,000. So according to this, the total capital of the firm should be 1,37,000, and the value of goodwill will be 22,000. So Anshu's share of capital 22,000 into 2 by 10. This is, if this is the firm's goodwill, value of firm's goodwill is this. Anshu's share will be this into 210, that is this. Anshu's current account will be debited. Now what is the accounting treatment? New partner to old partners in the sacrifice ratio. Sacrifice ratio in this question is equally. We distribute it equally. This is the value of goodwill. Value of goodwill is this. This is firm's goodwill. Value of firm's goodwill multiplied by the new profit sharing ratio of the partner or admitting partner, 2/10. So if firm's goodwill is this, new partner's share of goodwill is this, this will be given in the sacrifice ratio to the old partners, which is equal. Let us see how it is distributed. See now, capital account. The capital account of the three partners by balance brought down. This is the balance that has been brought down by revaluation profits given to both the partners, by Anshu's, this is Anshu's share of goodwill given to the old partners equally in the sacrifice ratio, that is equally, and by bank account, this is the goodwill, that is the capital that is brought in by the new partner Anshu, and this is the balance carried down of all the three partners, the balance carried down which will be shown in the opening balance sheet. See, this is the balance that is shown in the opening balance sheet after all the adjustments. What are the adjustments that we make in the balance sheet? You know how to make the balance sheet. Cash in hand, cash at bank, whatever is given there, the balance that is there, that only the thing that we add in the bank balance is the capital that is there, the cash that is there in bank, plus the new partner's capital, plus the new partner's goodwill. In case the new partner gets his share in cash, then all the assets at the revised values, all the liabilities at the revised values, and capitals as shown in the capital account. That will be the goodwill, the total firm of the capital of the firm. Are we clear? Now next we proceed to when the new partner brings in proportionate amount of capital.